Most people discover day trading the same way they discover a casino. They see the excitement first. A stock shoots up. Someone posts a massive profit screenshot. A trader turns a few $1,000s into a life-changing amount of money. And suddenly, the idea feels irresistible. Maybe this is the way out. Maybe this is how to escape a boring job. Maybe this is how to finally make money from a laptop, from anywhere, with total freedom. But Andrew Aziz opens How to Day Trade for a Living with a message every beginner needs to hear. Day trading is not a get-rich-quick scheme. It is a serious profession. And that one sentence changes everything. Because if you treat day trading like gambling, entertainment, or a fast way to escape your problems, the market will punish you quickly. But if you treat it like a real business, with training, tools, rules, discipline, and risk management, then you at least give yourself a chance to survive long enough to learn. That is the core of this book. Day trading is not about pressing buttons and hoping the chart goes up. It is about preparation. It is about patience. It is about knowing when not to trade. And most of all, it is about protecting your account so one emotional mistake does not wipe you out. What day trading really is. Day trading means buying and selling a financial instrument within the same trading day. In simple words, you open a trade and you close that trade before the market closes. You do not hold overnight. You do not hope tomorrow saves you. You do not turn a bad day trade into a long-term investment just because you cannot accept the loss. That rule matters because overnight positions carry risks you cannot control. Bad news can come after the market closes. A stock can gap down the next morning. A small loss can become a painful one before you even have a chance to react. So day traders focus only on what happens during the day. They are not usually asking, is this company a great business for the next 10 years? They are asking, is this stock moving today? Is there volume? Is there a catalyst? Are other traders watching it? Is there a setup with limited risk and enough potential reward? That is a very different mindset from investing. Investors care about long-term value. Swing traders may hold positions for days or weeks. Day traders care about intraday movement, speed, liquidity, and execution. And that is why Aziz says beginners must understand the game before putting real money at risk. The brutal truth: most traders fail. One of the most important warnings in the book is that day trading is extremely difficult. Aziz explains that a very high percentage of people who start day trading fail and lose money. And the reason is not just bad luck. They fail because they enter the market with the wrong mindset. They think day trading is easy. They trade too big too soon. They chase stocks without a plan. They ignore risk. They let emotions make decisions. They treat every trade like a lottery ticket. But the market is not a place where money appears out of nowhere. The money you want to win comes from other traders, and those traders are not trying to donate it to you. They are trying to take money from the market too. That means every trade is competitive. You are not just looking at a chart. You are competing against other people, algorithms, institutions, and traders with more experience, better tools, and stronger discipline. This is why the amateur mindset is so dangerous. An amateur asks, how much can I make? A professional asks, how much can I lose if I'm wrong? That difference is everything. Day trading must be treated like a business. Aziz compares day trading to serious professions like medicine, law, and engineering. No one expects to become a doctor after watching a few videos. No one expects to become a lawyer after reading one article. No one expects to build a bridge without years of training. But many beginners expect to make money in the market almost immediately. That is the first mistake. A real trader studies, practices, reviews mistakes, uses a simulator, learns strategies, builds routines, tracks performance, manages risk, protects capital. In other words, a real trader operates like a business owner. And like any business, day trading requires tools. Aziz highlights several essentials: enough trading capital, high-speed internet, a reliable broker, a fast execution platform, hotkeys for quick order entry, stock scanners, a community of traders. These tools matter because day trading is fast. If your platform freezes, your internet fails, your broker has poor execution, or you cannot find the right stocks, you are already behind. But tools alone do not create success. A beginner with expensive tools and no discipline is still dangerous to themselves. The tools only help if they are paired with a serious process. The difference between day trading and swing trading. A major distinction in the book is the difference between day trading and swing trading. Swing traders hold stocks for more than one day, often for several days or weeks. Because of that, they care more about the company, the larger trend, and what might happen overnight. Day traders do not think that way. They enter and exit on the same day. This gives day traders one big advantage. They do not have to care as much about the long-term quality of a company. A day trader might trade a stock from a weak company if that stock has volume, volatility, and a clear reason to move today. That may sound strange, but it makes sense. A day trader is not marrying the stock. They are not building a long-term relationship with the business. They are taking advantage of a short-term opportunity. But this also creates danger, because if you are only focused on short-term movement, you need rules. Without rules, fast movement becomes chaos. Going long and going short. Aziz explains two basic ways day traders can trade: going long and going short. Going long. Going long means buying a stock because you believe the price will rise. For example, if you buy at $20 and sell at $21, you make the difference. This is the style most beginners understand naturally. Buy low, sell higher. Going short. Shorting is different. When you short a stock, you borrow shares from your broker and sell them first, hoping the price falls. Later, you buy the shares back at a lower price and return them. If you short at $20 and cover at $18, you profit from the drop. Shorting can be powerful because stocks often fall faster than they rise. Fear tends to move markets quickly. When traders panic, selling can become aggressive, but shorting is also dangerous. When you go long, the most you can lose is the amount you invested in that trade. A stock can only go to zero, but when you short, the risk can be much larger because a stock can keep rising. In theory, there is no fixed ceiling. That is why beginners must be extremely careful with shorting. It requires experience, discipline, and strong risk controls. Retail traders versus institutional traders. One of the most useful parts of the book is Aziz's explanation of the trading battlefield. Not every trader in the market is the same. Retail traders are individuals trading their own money. They are regular people using personal accounts. Institutional traders are massive players: hedge funds, mutual funds, banks, and firms using advanced technology and large amounts of capital. Institutions often use algorithms and high-frequency trading systems that can execute orders in fractions of a second. A retail trader cannot beat those systems at their own game. That is why Aziz says, retail traders need to choose their battles carefully. Think of it like this. Institutional traders are like large armies with advanced weapons. Retail traders are more like guerrilla fighters. They survive by being selective, staying nimble, and waiting for the right opportunity. This means you should not try to trade every stock. You want stocks where retail traders have a chance. Stocks with real catalysts, strong volume, clear movement, and enough attention from other traders. The strength of many day trading strategies comes from the fact that many retail traders are watching and acting on similar patterns. When enough buyers or sellers show up, the stock can move. But if you are trading a stock controlled mostly by institutions and algorithms, you may be playing a game where the odds are stacked against you. The most important skill: risk management. Most beginners think trading is about predicting direction. Will the stock go up or down? But Aziz teaches that the real job of a day trader is not prediction. It is risk management. A good trader does not need to be right all the time. A good trader needs to make sure losses are controlled and winners are large enough to matter. That is why Aziz focuses on finding trades with low-risk entries and strong potential reward. A key idea is the risk-to-reward ratio. For example, if you risk $1 per share, you want the potential reward to be at least $2 per share. That gives you a 2-to-1 reward-to-risk ratio. This matters because even if you are wrong sometimes, your winners can still outweigh your losers. But without risk management, one bad trade can erase many good ones. That is why every trade needs a plan before entry. Where will you enter? Where will you stop out if you are wrong? Where will you take profit if you are right? How much are you willing to lose? Is the reward worth the risk? If you cannot answer those questions, you are not trading. You are guessing. Choosing the right stocks to trade. Aziz emphasizes that not every stock is worth trading. In fact, most stocks should be ignored. A good day trading stock usually needs a reason to move. This is called a catalyst. A catalyst might be earnings news, FDA approval or rejection, a merger or acquisition, a major contract win or loss, unexpected company news, a strong market reaction, a major gap up or gap down. Without a catalyst, price movement may be random, weak, or difficult to trade. Aziz also warns traders to avoid certain types of stocks dominated by institutional algorithms, stocks with low relative volume, highly manipulated penny stocks, stocks with no clear reason to move. This is important because beginners often chase whatever is moving without understanding why. But movement alone is not enough. You want movement with volume, attention, and a reason behind it. A stock that is moving because of a real catalyst is far more interesting than a stock drifting randomly. Share size. Trade small enough to think clearly. One of the biggest beginner mistakes is trading too large. When your position size is too big, your emotions get loud. A small pullback feels terrifying. A normal fluctuation feels like disaster. You stop following your plan because the money feels too real. That is why share size matters. Your position size should be based on your account size, your risk limit, and your stop loss, not your excitement. Aziz teaches that traders should define how much they are willing to risk before taking the trade. If your account is $25,000, risking 2% would mean a maximum of $500 on a trade. But Aziz also notes that this is an upper limit, not a target. Being more conservative is often wiser, especially for beginners. The goal is not to make the biggest possible profit on one trade. The goal is to stay alive, learn, and build consistency. Trading too big turns learning into survival panic. Trading small gives you room to improve. The stop loss. Your emergency exit. A stop loss is the price level where you admit the trade is not working and exit. This is not a sign of weakness, it is a sign of professionalism. Every trader is wrong sometimes. The difference is that professionals are wrong small. Amateurs are wrong big because they refuse to leave. A stop loss protects your account from emotional denial. Without a stop, a small loss can become a large loss. Then a large loss can become revenge trading, and revenge trading can destroy an account. The stop loss is your emergency exit. Before entering a trade, you should know exactly where that exit is, and when price reaches it, you get out. No arguments, no hoping, no moving the stop because you feel the stock will come back. Hope is not a strategy. The best time to trade, Aziz points out that the most active part of the trading day is usually near the market open. The first couple of hours after the US market opens can bring strong volatility and opportunity. But volatility is a double-edged sword. It can create profits, but it can also create fast losses. That is why preparation matters. A professional trader does not wake up at the opening bell and randomly click buttons. They prepare before the market opens. They scan for stocks gapping up or down. They look for news catalysts. They check volume. They build a watch list. They identify possible setups. They know what they are looking for before the chaos begins. This routine helps prevent emotional trading, because when the market opens, things move fast. If you do not have a plan, the market will create one for you, and it probably will not be a good one. Trading. Without a catalyst is gambling. One of the strongest practical lessons in the book is this. Do not trade just because a chart looks interesting. A stock should have a reason to move. If a stock gaps up, ask why. If volume is unusually high, ask why. If traders are watching it, ask why. The why matters. Without a catalyst, you may simply be reacting to noise, and noise can trap beginners quickly. Aziz's method is built around preparation. Scan the market, identify stocks in play, understand the catalyst, then wait for a setup. That order is important. Beginners often reverse it. They enter first, then look for reasons to justify the trade. Professionals do the opposite. They build the reason first. Then they wait for confirmation. The emotional battle of day trading charts matter. Strategies matter. Tools matter. But emotion may be the hardest part of trading. Fear makes you sell too early. Greed makes you stay too long. Hope makes you ignore your stop. Frustration makes you revenge trade. Overconfidence makes you increase size too quickly. This is why day trading is so difficult. You are not only battling the market, you are battling yourself. A trader can know the rules and still break them in the heat of the moment. That is why Aziz treats discipline as part of the profession. Good traders do not rely on motivation. They rely on systems. They have a daily routine. They have a risk limit. They have setups they understand. They stop trading after hitting their target or loss limit. They review their trades. They learn from mistakes. The goal is not to become emotionless. That is unrealistic. The goal is to build rules strong enough to protect you when emotions show up. How to apply this book as a beginner. If you are new to day trading, the most important takeaway is not start trading tomorrow. The real takeaway is start learning like a professional. Begin with education. Understand the difference between investing, swing trading, and day trading. Learn basic order types, chart patterns, volume, catalysts, risk to reward, and position sizing. Then practice in a simulator before using real money. A simulator lets you experience speed, decision-making, and mistakes without destroying your account. It will not perfectly match real emotions, but it helps you build pattern recognition and process. Next, create a trading plan. Your plan should define what stocks you trade, what setups you use, what time of day you trade, how much you risk per trade, what your daily max loss is, when you stop trading, how you review performance, then start small. Do not judge yourself by how much money you make at first. Judge yourself by whether you followed your rules. For beginners, discipline is the first profit, because if you cannot follow rules with small size, larger size will only expose the problem faster. Final takeaway: survival comes before success. How to day trade for a living is not a fantasy about easy money. It is a warning, a framework, and a beginner's map. Andrew Aziz's message is clear. Day trading can be done professionally, but it must be respected. The market is competitive. Most beginners lose. Tools matter. Preparation matters. Catalysts matter. Community matters. Risk management matters more than prediction. And discipline matters more than excitement. The biggest mistake is thinking the goal is to make money quickly. The real first goal is to survive. Survive long enough to learn. Learn long enough to build skill. Build skill long enough to become consistent. And only then does trading become a serious business. So before you risk real money, ask yourself, am I treating this like a profession or like a shortcut? Because the market does not reward excitement. It rewards preparation, patience, and discipline. If you take one lesson from this book, take this. Your job as a trader is not to win every trade. Your job is to protect your capital, follow your rules, and wait for the right opportunities. Start with education. Practice in simulation. Build your process. Keep your risk small. Review every trade. And remember, in day trading, freedom does not come from chasing every move. It comes from mastering yourself before you try to master the market.